Hello, and welcome to Private Market Talks. I'm your host, Peter Antushik. Today, I'm speaking with Caroline Cooley. Caroline is a veteran in the alternative investment industry. She is a managing partner at Crestline Investors and the chief investment officer for Crestline Summit Strategy, Crestline's hedge fund unit. Crestline Summit is a multi-strategy, multi-portfolio asset manager that employs an equity-oriented, market-neutral investment strategy. Over the past 25 years, Caroline has helped build Crestline into the multi-billion-dollar asset manager that it is today. Crestline Summit's emergence as a hedge fund asset manager is unique, and its growth is in no small part due to Caroline's background, drive, and moral compass. In today's episode, we discuss how Crestline's hedge fund-to-funds business has evolved since the great financial crisis, and how Crestline Summit found a better way to deliver alpha to its investors that was pure and liquid. We also explore Crestline Summit's current investment strategy, trends in beta-neutral equity investing, and how Caroline thinks about risk management. Finally, we cover Caroline's path to covering one of the largest books in the country as a female CIO. Joining me today is my partner, Kelli Moll. Kelli is a partner in Proskauer's private investment funds practice and is co-head of the hedge fund practice. As always, you can get a full transcript of this episode and other helpful information at privatemarkettalks.com. And don't forget to subscribe. And now, my conversation with Caroline and Kelli. Caroline, Kelli, welcome to Private Market Talks.
Thank you, Peter.
Caroline, my first question is can you still walk on your hands?
Oh, that's good. That's good. So apparently that's now legendary. I was actively trading when the stock market crashed in 1987. And rumor has it I walked on my hands to celebrate, but really I walked on my hands to relieve stress across the trading room, got done, went back to my desk and continued trading. But that story lives on.
There you go. And so what do you do to relieve stress today if you're not walking on your hands?
I run. I'm a person who runs. I'm not a runner, but it works for me.
So Crestline started, I believe, as a fund-to-fund structure, but has since evolved. And before we talk about the evolution of Crestline Investors and the emergence of Crestline Summit more specifically, I think it would be helpful to provide our listeners with some context. So could you describe how the structure of the hedge fund industry has changed since the GFC?
So let's just kind of think about hedge funds broadly, what they do, how they different ways to structure them. So the traditional hedge fund, original hedge funds were really long, short equity strategies. Long stocks, short stocks, maybe had some market beta, one manager with a team under him or her, and very simple in concept and actually fairly simple in structure. Step two, really, hedge funds developed multi-strategy approaches. So, hey, I've got this really great portfolio manager at the helm. I want to diversify my return stream, but I still have one decision maker. I have one performance fee, but I have more things kind of going on beneath the hood. Okay. Next iteration really was the fund of funds concept. So it was, okay, well, I want more than one decision maker. I want to diversify the portfolio. Investors wanted broad exposure to the hedge fund industry. So fund of funds kind of evolved, right? And they gave you a diversified return stream, multiple decision makers, lots of different sources of alpha and stock picking, bonds, whatever. But the problem with the fund of funds really was that it's harder to move capital around. The balance sheet usage was inefficient. So kind of there's some inefficiencies built into that model. And so really the next iteration, and I think kind of the current area of growth in the hedge fund industry is now the hedge fund platform model, which kind of takes some of the best aspects of the multi-strategy portfolio and some of the better aspects of a fund of funds. But it's really solving some problems. Number one, balance sheet usage is better. So in a multi-PM or a platform model, there's multiple decision makers, but one balance sheet. So the capital usage is much more efficient. You get a centralized decision-making process. So you have multiple portfolio managers picking your stocks or delivering your alpha, so to speak. It's a different compensation structure. So unlike a multi-strategy fund, the multi-PM model pays each portfolio manager based on their own performance rather than the performance of the whole portfolio, and then people have to fight over it. And I think if I had to say although it makes the model technically more expensive, it creates a alignment of interests such that the best talent chooses to work at a platform because they can get paid if they do well. And that's really one of the reasons I think that the performance in that structure has been better overall within the hedge fund universe.
I'd like to bring Kelli into the conversation now. Kelli, what are your thoughts on the evolution of the hedge fund platform model?
Thanks, Peter. I want to start by just saying I concur with Carolyn's summary of the evolution in the industry. And although we still see all of these models in the marketplace, the trend of the multi-PM platforms are now a dominating force, particularly appealing for emerging portfolio managers. But one of the things that the platform model raises is really two issues. First are, hiring the right folks or the right managers. And the second is the cost to investors. In turning to costs, many platforms have significant investment in operating costs, as well as passing through talent acquisition and compensation to each separate portfolio management group. The pass-through of separate PM compensation to investors can result in netting risk, which generally occurs if a fund suffers losses in a year, but portfolio managers are still receiving a share of the profits that such PMs generated. Investors always complain about fees, but in particular in these structures, complain about the layering of all of these fees. I'd like to turn it back to you, Caroline, to ask you how you think investors react to the expense structure of the platform model, and in particular, the netting risk.
So you've kind of hit on both the benefit and the negative of the strategy. And some investors, understandably to some degree, don't get over it. It's expensive, right? They don't want to see that they are taking the netting risk. But more investors by and large look through to the net return and say, hey, this is the cost of generating alpha. Generating returns from something other than direction in the market is very, very hard. It is a very difficult way to make a living. And the people that are good at it want to do get paid for that skill. And so it's kind of, you have to opt in or out in a way. And more investors have moved to opting in because of the net results of the types of strategies. So
from the CIO's perspective, selecting the manager is key.
Selecting the manager is key. And there's two keys: selecting the manager and managing the risk.
And in terms of selecting the manager, from your perspective, what goes into selecting the manager?
That's a very good question. First off, it's a dual-edged process. I have to select them, and they have to want to join me, right? So we look for PMs who are portfolio managers who are highly experienced, and so track record matters to us quite a bit. But it's not just track record; it is process. We probably, people approach their underwriting of portfolio managers and talent differently. We take our time to make sure we really understand the source of the return. We spend a lot of time to make sure the portfolio manager's risk management and portfolio construction is balanced. That will be important to us when we construct the pieces to deliver what we're trying to get. So it's track record, it's process, it's risk management, all of those things combined in reviewing the portfolio managers.
And so when you think about process, when you talk about process, just to be clear, you're talking about the manager's process.
That is correct. So I'm basically there's people who kind of trade on feel, or, that doesn't really work for what we're trying to do long term, right? It's what you are going to pick stocks in your sector. Ideally you're an expert in your sector. You've honed your skill over a long period of time. You know how to model the company. You know how to define what is priced into a stock and what's not, what's differentiating this company from others, and be able to assess the strategy you're looking at on a relative value basis.
Do you think the way you look at a manager is different than others in the industry? I mean, how would you differentiate your selection process
I actually think it's more thorough, and I don't want to really talk about others and what they do versus what I do, because I don't really know what they do. I will just say that some others hire more quickly than we do, and that might lead them to fire more quickly than we do. And we want our secret sauce to be hiring well on the front end. So we spend a considerable amount of time working with a portfolio manager before we onboard them.
You actually touch upon a question I have, which is, how do you determine when to get off a relationship with a manager?
Well, and that's tricky. It is, again, it's a hard job. And because of the math, I say, even though you've hired people you like and you think long-term their performance might be really good and they're great people and you've done all this work on the culture, the fact of the matter is you have to deliver a return to your client, and the model is expensive. So generally speaking, we have to give a portfolio manager a certain period of time or a certain amount of risk capital that they can lose. And if a certain period of time or a certain amount of risk they're not successful, we do have to move on and find someone else in the seat.
Carolyn, as you know, pathway for emerging hedge fund managers has changed considerably, from talent originating at prop desks of investment banks before the global financial crisis to post-global financial crisis, emerging managers coming from generally existing shops. As a hedge fund business and the regulatory environment continues to be challenging, the question we often get from emerging managers is, should I go onto a platform or should I start my own firm? Carolyn, how do you address those questions when you're meeting with potential portfolio managers for Crestline?
Right. So let's talk first on the decision, should I start my own or should I join a platform? I'm a tech PM. I've been trading stocks for 10 years. I've been on a couple platforms. What's the next step in my career? Launching your own hedge fund is harder now. It is the seed capital is harder to get. Investor capital has generally been going more tilted towards the platforms rather than single strategies. So raising assets is hard. The costs of managing the business have increased. Regulatory environment has gotten more aggressive. Peter, you'll like this. We're calling it a bull market for hedge fund attorneys because of the more aggressive stance of the regulators. You will like that too, Kelly, right? So it's harder. One of the things we've thought of when launching ours was trying to imagine a world where they don't have to make one choice or the other, but maybe something in between. So we have supported portfolio managers who want to launch by themselves, but are willing to manage a separately managed account on behalf of our clients on the same balance sheet, so that they can launch a fund, have some investment capital that's not in their fund, but they're managing it and getting fees off of it, and that way they can, to some degree, be positioned in case there's people who want to go into a commingled fund, then they have a vehicle already up and running. But it is a tough choice for people, and some of them want nothing to do with managing a business. They really just want to invest in stocks, and they don't want to manage a business. Yeah, we call it an open architecture concept, that, we are open to how we structure the relationship with our portfolio managers, right? And I think we've seen more platforms move that direction. It used to be you had to be an employee, and more of them now also have this. But we have this, we're now in our 9th year, and we've been doing it this way from the start. It is, in fact, Peter and Kelly, the most frequent question we get. The most frequent question is, how do you compete for talent in a world where there's some really very large platforms and, there's only so much alpha out there. And I always, when people ask me that, I kind of look at them and say, okay, you have a job. You took your job because you're going to get paid well, and 20 other reasons. And how much pay you're going to get, what my salary is, how much capital they're going to give me are really important, but they're not the only important things. There's things like the culture of the firm. Do you collaborate? Do I have to be by myself? Where am I located? There's the risk controls and the risk guidelines we give you. Are the risk guidelines broad enough for me to do my job? What's the career path look like here? What are the resources you give me? How transparent are you about the costs I'm going to get assigned, or how the direction of the business that might impact me? Do I have access to the leadership at the firm? Can I talk to the CIO, the head of equities, or am I just just a guy or a woman on some remote island doing my thing and just collecting a paycheck? So it's that whole package, and I think treating people like people rather than, in fact, I try not. People call this part talent sourcing, and I call it hiring people. And I try to tell my people, we're not looking for talent, we're hiring people. And again, I think that's a different mindset.
You really make a good point about transparency and access to leadership. In particular, as Crestline's been an early adopter of open architecture, and as the competition is certainly getting tougher to attract managers to platforms, particularly your platform, I think that philosophy about transparency and access to leadership can be a differentiating factor for portfolio managers.
Thank you.
How does your compensation structure fit into the ability to attract and retain talent?
Compensation is market driven. So you are going to pay the rate you need to pay to a portfolio manager to hire them. Like they get paid based on their performance, and payouts are, you want to pay people in order to attract them. I don't know how else to say that. I want to negotiate as best as I can for my clients, sure. But I'm not about to lose hiring the best talent for, I'm not going to be penny wise and pound foolish when it comes to bringing in people that help them generate returns.
So let's pivot to Crestline and its business. Can you describe the evolution of Crestline Investors and the emergence of Crestline Summit?
Crestline Investors was originally formed as a family office. So our roots go back to the Bass Brothers organization, which is a firm I started at in the 80s. And I can talk about that a little bit later. But Bass organization was a breeding ground for many alternative investment managers out there, a really great place to cut one's teeth and learn. So we've originally spun out from the broader Bass organization, formed Crestline for one of the brothers, and invested in external portfolio managers while also managing assets for Bass family members on their balance sheet. But the external portfolio allocations, external manager allocations, we grew into a fund of funds business. So for the first, let's call it 15 years of Crestline, the primary business was a fund of funds. I was the CIO of that. We were a decent sized player in that world, but we have really done a great job evolving over the years, and really multiple times. So first from a family office to a fund of funds, then fund of funds really evolved around the time of the great financial crisis. And it evolved to get more data and more illiquid. And at the same time, the institutional investor universe, kind of the blue chip investors who we were managing capital for, became more sophisticated, could make hedge fund allocations themselves. We pivoted in two ways. First, we moved into what I'm going to call opportunistic credit, or that area between hedge funds and private equity, hired a team and built out and developed what is now a very large credit-oriented business, private credit, that is the largest part of Crestline. The fund of funds, the investors I've had there, the mandate has generally been liquid, low beta, low market exposure, diversifying strategies. And we thought hard about what was the best way to reimagine that business and have a better alpha engine, so to speak, a better engine for delivering turns that weren't correlated to the market. And we decided to pivot to the hedge fund platform business model, specifically focused on equity market neutral strategies where we'd had very good success prior. And so we pivoted to that business, started around 2015, exited the hedge fund business itself in about 2017, and our investors were along for the ride. So, and then we've grown the Crestline Summit business very nicely since then.
You want to describe for our listeners the market neutral equity strategy?
Sure. And I think it's such a tongue twister. Crestline Summit, market neutral, multi-strategy, multi-PM, a lot of words there. Multi-strategy, first off, multi-strategy, meaning we have more than one approach to generating returns and then multi-portfolio manager, meaning I have a decentralized and distributed decision-making process for selecting stocks. We run near market neutral. So that means I'm long stocks, I'm short stocks. I have, in almost equal amounts. So we seek to generate returns primarily through stock selection rather than timing the market. And as we mentioned already, my job is to identify, hire, and manage portfolio managers who are making the stock selections and then manage the risk between them. So right now we have most of our portfolio managers are sector specialists, meaning they are fundamental stock pickers who may specialize in financials or technology or healthcare. We also have managers who are specialists in more tactical strategies. Think about arbitrage related strategies, or portfolio managers who invest in merger events or capital markets transactions. And then we have portfolio managers who are quantitatively oriented. They may be selecting stocks based on some quantitative models. So all of these different sources combine. Each of the portfolio managers is themselves a risk manager, and then we have a layer of risk management on top as well.
You may have answered this question by implication of what you just said, but there's a theory that asset allocation drives alpha as more so than security selection itself. And I'm just curious, from your perspective, how do you think about that in the hedge fund context? Do you start with areas of broad opportunity sets that might be attractive, or do you think about it more from a bottoms-up approach and work with managers and let the opportunity set fall where
it is more bottom up, and it's very interesting. If you think about how do people use a strategy like ours, we've taken out that asset allocation part. It's not there, so you don't get the beta to the market, but we're really good at stock selection. So what a number of investors, actually a fairly large number of investors, do is they take this return that's almost all stock selection, and then they add the beta on top of it. So if you combine this alpha generating, this return that's just stock picking, and then you add, let's just call it S&P exposure through futures or some other derivative, the combined package is designed to outperform equities by whatever amount of alpha you're generating. And that's a pretty powerful structure. Some investors kind of structure that on their own, on their balance sheet. And then there are some, we have a product, for instance, and there's some others out there that you can combine the alpha and the beta all in one product and get back to the asset allocation. But that alpha part is hard, and that's what we do.
So Carolyn, how do you think about your portfolio managers relative to industry sectors? Do you have one PM for each vertical or sector, or are you employing more than one?
We will have more than one generally. And what you really want is people whose skills or portfolios really, either their styles or their portfolios complement rather than overlap or offset the other portfolio managers in there. So you might have a technology specialist in software, and you might have a technology specialist in semiconductors, or you might have financials PMs who are longer duration trading views, and some who are shorter mean reversion type of portfolio managers. So in most sectors, we have more than one portfolio
looking
manager.
For complementary skill set.
What trends are you seeing in market neutral equity investing?
I think there's been a good development in risk management in market neutral equity investing. So if you kind of went back to the start, we used to define market neutral as market neutral. You're long a dollar and you're short a dollar. And then we got really sophisticated and we said, no, market neutral means what is my beta on the long side and what is my beta on the short side? And really now we've gone to, it's not just my beta, it's what other factors am I exposed to in my portfolio, such that when I construct it, it's more resilient to rotations within the stock market. Am I exposed to value, or am I overexposed to the latest momentum move? And so the trends have been to find better tools to manage some of these exposures.
What are some of those tools that you might use to manage some of those exposures?
And that's a good question too. So really, we have some factor-oriented tools, a couple of kind of some off-the-shelf, and then some internally developed proprietary tools to kind of look real time into the portfolio and see what some of these factors are, both the, let's call it standard factors that are in most risk models, but then broadening that out to other themes that might be prevalent in the market. That's how we have it.
So I'm kind of curious about your story, how you navigated to become a successful investor and CIO in frankly, in an industry not known for having many women in senior leadership.
I'm actually going to start with my move to Texas. I was working for a money center bank in New York, moved to Chicago because I was involved in the futures industry, and was moving to Texas to get married, and asked around and found that the best place to work in Texas and in Dallas, in Texas, and actually premier shop in the country was at the Bass Brothers. They were doing some of the most interesting things. They were innovative, opportunistic. They were hiring people from top shops on Wall Street and bring them down to Fort Worth. So I picked up the phone and I called the Basses. I was nice to the gatekeeper, which is always important. Got through to Tommy Taylor, who managed the trading operation, and got myself a job on the trading desk. Bass Brothers was an unbelievable place to learn. So I started there very young. I was in my early mid-20s. I had a derivatives background. As the derivatives trader, one also slides into risk management roles. That was an organization that gave a tremendous amount of responsibility, now that I think about it, to people at young points in their career. So I happen to be the risk manager and managing hedges across over $1 billion, call it over $1 billion, just call it that, portfolio when the stock market crashed in 1987. And we made a lot of money. It was the best trading day we'd had to that point.
I'm enjoying the Bass story, given how many prominent firms really spun out of really the seeding ground that firm was, for really a lot of the big household names that really came out of that. But it's interesting that was your formative years.
That's right.
It didn't crash.
I learned a lot about investing and developed investment philosophies. And I kind of think that your early career really matters in shaping you as an investor. So I worked at a shop where you were always opportunistic, but we were always interested in controlling the downside. It was already kind of a stay rich mentality at the shop I worked at. And that investment philosophy, be opportunistic, know that if you go into a situation with strong hands, it will pay. Like, it absolutely pays to have strong hands. And if you're going to be hedged, you want to hedge going into the event. You don't want to be the guy who says, oh my gosh, the market's selling off, I need to get hedged now. So, hedge ahead of the event. It pays to have strong hands. You can be opportunistic and protect the downside. So those were really, really important kind of early learning experiences for me. So I'm going to pause there before I could just keep talking, Peter.
Yeah, no, I think identifying those, early learning experiences, which I found in my own career to be formative and have carried through. I'd be curious to know how the significant steps that you took from that point to landing at the CIO seat, and who helped you along the way.
I honestly learned from, just really great people who were there. Like, we talk about risk management, for instance, and this is a risk management lesson learned over that period. Because risk management, and we talked about tools matter, and tools have gotten better. But risk management is both an art and a science. And the art part typically comes from experience. The science part you can have right away. But the art part comes from being in the seat for a long period of time. And I learned from some great people. So there's one portfolio manager that was traded deal stocks generally. But anyway, there was a day where boss says, Caroline, you need to get risk down. I want you to talk to portfolio managers, tell them to hedge up. They need to hedge their book. And I call a portfolio manager, hey, you need to hedge your book. Boss said we need to hedge your book. You need to cut this much beta out of your book. And he said, Caroline, if you want me to cut my risk, I'll just take the book down. That's the best way to cut risk. And it's so obvious, but there's a difference. There's a time where putting a hedge on is the right risk management, and a time when taking your gross exposure down is the only thing to do. That's an art. And, do I always get that right? No. But do I know there's a difference? Yes. There are times when the leverage will hurt you, and the best risk is to take your book down. There's times when the market can hurt you, and it's absolutely fine to just go short some S&P futures or whatever your hedge mechanism is to get that down.
Sitting in the CIO's seat now,
right,
for some time, what makes for a great CIO?
So that's a good question too. I think, and actually I'm going to meld this into, you asked me a question about being a woman CIO and how that mattered, because I think a lot of women have this perception, or a lot of people have a perception, that investing, especially hedge fund investing, requires some kind of machismo. I have to be macho. I have to be a big risk taker. And I think, first of all, the most important thing is having a really good understanding of the risk return trade-off. Because being a good risk taker means you are taking risk. So what risks should I take in order to achieve the return I want? So number one thing is really, really, really understand the trade-off between risk and return and where you want to be on that spectrum. The other is, at least in my experience, you have to be as good a listener as you are a talker. Your ideas can come from anywhere. I operate in a more collaborative environment than in a autocracy, so to speak, right? So I want to hear. Somebody has to ultimately make the final call on most things, but hearing and listening is really important. And the other is, honestly, being a good CIO is as much about managing people as it is about managing a portfolio. And I think not everybody gets that. Right. I think they think it's all about investing, but it's about managing people and about managing investment.
Certainly the perception could be it's all about numbers.
Correct. And
you lose sight of somebody has to generate those numbers. Somebody has to put a strategy together. Somebody has to manage a portfolio, and that takes talent.
And you have to create an environment that helps people succeed, that respects people's opinions.
And allows people really to collaborate with each other.
Correct.
An environment where you've got a level of openness that people are willing to share ideas to each other. Right.
Yeah.
So I hesitate to bounce around a little on you, but I'm going to do it anyway, because you mentioned it as one of two most important things, I think, in selecting a manager was skill and risk and risk management. And so I'd like to, if you don't mind, just come back to the risk management piece, because we didn't really cover that, but it is, as you said, one of the two most important things. So I'm curious as to how you think about risk management and the components of it.
So first off, the risk management is staying within the box that you've been kind of outlined, right? So if I'm trying to be neutral to the market, my first thing about risk management is staying within those guidelines that I've talked about, right? The other part of risk management is avoiding drawdowns. So constructing a portfolio that is resilient to drawdowns and having a game plan of how to manage those drawdowns if they do happen. Then there's other aspects to risk management. So liquidity management is one, balance sheet management. How levered are you relative to the liquidity of your portfolio? How quickly can you move your portfolio? And I think a good risk management process has the tools to measure those risks, and then people who are empowered to kind of make decisions and take it down. In our framework, we have kind of two levels of risk management, right? So when I hire portfolio managers, they themselves have to be risk managers. They have to run within a set of risk guidelines, and then risk management at the portfolio level, where when we aggregate things, you can still have exposures surface that need to be hedged or reduced in some way at the portfolio level. So both of those are important to us.
You were talking about sort of like obviously setting risk parameters to fit within the box that you drew in terms of what you're trying to get for alpha. A lot of managers over time that I've worked with that have gone onto platforms, that onboarding of negotiating those risk guidelines are sometimes a subject of conversation. Do you have like one set, or do you tailor them for different managers in terms of your assessment?
Sure. They're all tailored to every PM. So they're not one size fits all. And we just had a call yesterday with a portfolio manager we're onboarding. And our kind of intro to the conversation, it goes like, we've made a decision to move forward to hire you. We want to create a box that enables you to succeed in the manner that you have been used to making money and that you intend to make money going forward. And that is aligned with the strategy that we underwrote. So we see that you have had this amount of exposure to the market over your history. We're going to set your guideline here. We don't want you to go over that. And it's a really good approach. It resonates. I don't want to, the flip side would be to, and you see people do this, they find a portfolio manager who's been very successful with a concentrated portfolio, let's just say. And they say, well, our risk guidelines are you can't have any stock more than 1% position limit. When the portfolio manager has only ever managed a portfolio of 20 stocks, it's not going to work. So we absolutely tailor the guidelines and then it becomes a question of sizing. So given the guidelines I've given you, how big, the riskier you are, the more volatile you are, the less capital I'm able to give you.
How do you think about assessing and incorporating geopolitical risk?
Interestingly, it's not different. So geopolitical risk is risk. So at the end of the day, it's geopolitical risk will come back to market risk. It's the same risks that I'm looking at. It's just a different cause of the same risks I'm trying to take. So geopolitical risk may cause a big move in the stock market down. I'm already addressing stock market might go down. So in most cases, the geopolitical environment is a risk factor that impacts all of the other risks I'm trying to control, except my exception there are some times where geopolitical risk can create a situation where you just don't want to be in certain countries, not because the market direction, but again, because of the concept that you might not be able to get your money out. So when the Russia-Ukraine war began and people had exposure to Russia, the biggest concern wasn't that they had exposure to Russia, it's that they had exposure to Russia and they couldn't get it out. They couldn't sell the stocks. If you were short, you couldn't, even if you made money, you couldn't get your money out. And those kinds of risks, typically, again, you have to be on top of it ahead of time. And if you are really concerned about those, don't go there. And that's how I approach that. If that's my concern, we just won't be there at all. I've another lesson that was learned the hard way. I had money tied up on an exchange that went under in 1987. And so I am very much, I kind of, again, always have in the back of my mind, you know what? Sometimes it's not this market direction. Sometimes the exchange goes under and you have to worry about getting your money out. And, and that's a much bigger problem than did I get the direction of the market right or wrong? And was I hedged?
I just have a couple of final questions. This has been a great conversation. So thank you. Kind of curious from your perspective, your view of the market and whether it is overvalued and at a very risky point.
Okay. So that's, so what's been going on? So the market above anything else has been focused on the Fed and what is the Fed going to do? The obvious, in hindsight now, the obvious buy signal is not when the Fed cuts rates, it's when the Fed stops raising rates. That's the pivot. The pivot is I'm going from tighter to loosening. It doesn't necessarily matter when it happens. I've stopped raising rates. That's now happened. The market's now pricing in soft landing, no landing. And it feels like it's been a big rally, and the rally has been narrow. Okay. That said, the things that have rallied, the things that have led are real. So AI is real. It is a long-term investment theme with great companies. And to the extent the market leadership has been in sectors that have rallied because they should, that's a little less concerning. You'll hear, if you talk to some of the strategies, that breadth is starting to improve. So some of these sectors that have kind of been left behind a little bit are starting to see a little bit of better traction in earnings, and you're starting to see some improvement because of that. So I'm a market neutral investor. That makes me always a little bearish. And I always have to almost caution myself to not be more bearish than I need to be. I have a Fed that's probably on the margin moving the right direction to support the market. I have some stocks that haven't appreciated with the rest. I have a little bit over. So I'm not going to give you an outright answer. I would be not obviously hugely bullish, but you're not supposed to fight the Fed. I'm putting that in air quotes for those of you who can't see me. But there's absolutely risks out there, and I'm very much aware of them.
Yep. So, final question:
Shoot.
What trait do you have that makes you successful that you think is underappreciated?
Oh man, that's a tough one. I hate talking about myself, Peter. I've spent a whole hour talking about myself, but that one's a little more personal. Okay. Okay. So I have I think I'm a very measured personality. Like I'm not an emotional investor, right? I don't get mad easily. I don't get ecstatic. I have a very measured personality. I delegate well. I'm not a dictator. I'm a collaborator. I think sometimes that shows up in things like, and I'm gonna give you a woman answer here. Things like negotiating. You know how when you were a kid and you got in trouble and dad yelled at you, or your dad, I don't know if your dad had a temper, but your dad would be likely to. Most dads would be likely to get mad in a certain way, but your mom says, "I am so disappointed in you," and that impacted you more than your dad yelling at you. I feel like that's more my personality. Like I'm negotiating, I can't get it, or I'm just really disappointed in you that you can't do that for me, and I think that works. So I think I'm generally that would be it. I don't know if that's what you're looking for. But
I love that story, and I love the fact that we're ending it there.
Okay.
Thank you so much for joining us on Private Market Talks.
You're welcome, Peter. Thank you. Thank you, Kelli.
Kelli.
Thank you.
And thank you, listeners, for listening to this episode of Private Market Talks. And again, don't forget to subscribe.